Hello everyone and welcome back to my channel, or welcome to my channel if this is your first video. Today I'm talking about loss harvesting to reduce tax on share and crypto trades. Loss harvesting is an investor strategy to unlock losses on assets within a portfolio which are underwater. The rationale is for those losses to be offset against actual gains realized in the same year or in a later year. It's a way to reduce your immediate tax exposure and improve cash flow for better investing. The strategy is appealing because there are few alternative ways under Irish law to reduce CGT. Many countries have annual exemptions that can be used to reduce taxable gains. In Ireland, the exemption is a paltry €1,270. The exemption expires if unused because it can't be rolled forward. And some investors do sell profitable holdings to use the exemption, but it hardly seems worth the effort. Most countries also have rules designed to prevent the creation of losses through short-term sales. In Ireland, the restriction is known as the 4-week rule. The 4-week rule attempts to prevent investors from unlocking losses on sales of shares within a 4-week window. The key word there is sales of shares. The rule doesn't apply to other assets, and for that reason, holders of crypto might like to jump ahead to where I discuss practical considerations for crypto investors. For now, I'll talk about loss harvesting using a couple of examples. The first technique involves an acquisition of more shares in an underwater investment, followed by the triggering of a gain on a profitable investment. In the first example, Emma owns 200 shares in XYZ Corp, initially purchased at €50 each, totaling €10,000. The share price has dropped to €25, reducing the total value of her investment to €5,000. She decides to buy 100 shares on Monday at €25 per share. This brings her total shareholding up to 300 shares. On Friday, she sells 100 of her original shares at €25, hoping to realise a capital loss of €2,500. Now, her expectation is that the normal CGT FIFO rules, first in, first out, will apply when calculating her capital gain or loss. And she intends to use the loss generated, €2,500, to shelter gains from other investments. The acquisition of new shares on Monday may or not have been carried out in anticipation of a partial sale of her existing holding later in the week. But because there is no subjectivity allowed, and there's no bona fide testing allowed either, the 4-week rule will automatically apply. The outcome of this is that while the normal share identification rule for CGT purposes is first in, first out, i.e. where you look at the earliest purchase, in this case, that rule is overridden with LIFO, last in, first out, applying instead. The base cost attaching to the share disposal is that of the most recent purchase, €25 rather than €50. The true economic outcome is therefore ignored, and the acquisition and disposal are treated as tax neutral. The second technique involves a disposal followed by a reacquisition of shares in the same entity. In this example, Sarah owns 150 shares in Def Corp, originally purchased at €80 each, and her total carrying cost is €12,000. The current share price in Def Corp has dropped to €20, making her holding worth €3,500. Because she expects to realise a gain on other investments, she decides to unlock part of the carrying loss in her DEF Corp shares. Sarah sells 75 shares in DEF on Monday for €1,500, the current price. The sale generates a capital loss of €4,500, which she hopes to offset against other capital gains. At the same time, she remains interested in DEF Corp and she uses the proceeds to reacquire 75 shares in that company before the end of the week. And it's this reacquisition that's going to trigger a problem for her. While the disposal and reacquisition may or may not have been connected, the 4-week rule is going to apply here also. The $4,500 loss that has been realised is going to be ring-fenced, and instead of being available for offset against other investments, it can only be applied against future gains made on the sale of DEF shares. So, the 4-week rule is intended to prevent taxpayers from selling shares to unlock capital losses, only to repurchase those shares with no fundamental change to their portfolio. Now, in practice, because of the way the legislation is drafted, there are several workarounds that can be used to ensure that the restriction does not apply. They're not obvious, and advice would need to be taken from an expert in order to do one of these workarounds. Does the 4-week rule apply to all assets? No. As I said at the beginning, the 4-week rule applies to shares and securities. It doesn't apply to other assets like cryptocurrencies or crypto assets. Therefore, while loss harvesting may be restricted in relation to shares, it very much remains an option for holders of crypto. There are a number of practical considerations to be aware of, whether you invest in shares or crypto or both. You should be familiar with the CGT share identification rules, as these will impact how your CGT is calculated. These rules include FIFO, first in, first out, LIFO, last in, last out, connected party transaction rules, negligible value rules, and the 4-week rule we just talked about. CGT is calculated on a calendar year basis. Losses can only be used against gains arising in the same calendar year or in a subsequent calendar year. They cannot be carried back. Crypto investors can offload and immediately reacquire crypto, which is very helpful given the volatile nature of these assets. Disposals should be made to an unrelated party, not a connected family member, and certainly not a spouse. So large crypto investors may correctly prioritize security over small tax savings. It's possible, though, to loss harvest without trading openly. One option would be to consider selling crypto to a third party under an option arrangement that provides for reacquisition at a particular price and time. You can maintain control over the asset without releasing the crypto keys to another person. When done right, tax loss harvesting is a very useful strategy for managing tax liabilities, particularly for crypto asset holders who benefit from fewer restrictions compared to traditional asset investors. Even if you think the 4-week rule applies, you should take advice because there are opportunities for planning. I hope you've learned something useful, something you didn't know already. If you have questions, please leave them in the comments below. Please also hit like and subscribe if you like this content, and remember, we're here to help. For now, thank you for watching.